Very good morning to you. Tell us more about your comments there about how the Reserve Bank is hampering our growth.
Yes, it's probably also a form of sabotage as far as I'm concerned, because their policy is totally out of synchronization with most of our major trading partners. I've done an analysis which shows that a real repo rate, that's now our central bank rate, official rate, adjusted for inflation, is on average more than 200 basis points higher than the average for our major trading partners. If you calculate it on a trade-weighted basis, it's probably closer to 300 basis points. The point I'm trying to make is that the days of speculating over a 25 basis points Mickey Mouse decline in the repo rate are over. This country needs a very deep cut of at least 200 basis points in the repo rate to resuscitate growth in South Africa.
Why do you think we are so out of sync? What is it that's holding us back?
Well, I must be quite honest, it is a total mystery to me, because it is well known that there is an inverse correlation between money market rates and GDP growth. And I've also gone to the trouble recently of looking at the change in policy that occurred after Jill Marcus's departure, when a new monetary policy committee was appointed by then President Jacob Zuma. And since then, the average real prime rate has gone from 3% to more than 6%. That is an increase of more than 100% in the cost of capital and the cost of credit in real terms, which is ludicrous. It is absolutely incomprehensible. And what I've done is I've calculated the effect on private sector credit extension, which has a very strong positive correlation with GDP growth. That relationship in real terms is about 1.7. 1.7 increase in private sector credit gives you 1% growth in GDP. And we have lost, if the monetary policy had stayed the same as it was in Jill Marcus's time, and private sector credit had grown at the same rate, our GDP would have been 290 billion rand higher, and Mr. Tito Mboweni would have had 75 billion rand more in his pocket over the last 3 years than he's got today. So quite frankly, I just don't understand what the hell is going on at the Reserve Bank's Monetary Policy Committee.
Fair enough. I mean, is economic growth part of its mandate? Are we just not expecting too much from the Reserve Bank here?
Well, you know, the plot thickens, because the Reserve Bank's mandate is very specific about striking a balance between combating inflation, called price stability, and securing sufficient growth and employment creation. And that's no different from any central bank in the world. But for some unexplainable reason, ever since Jill Marcus retired as Governor of the Reserve Bank, it seems as if the Monetary Policy Committee has just lost sight of the need to also look at economic growth. And even Moody's Investor Services have admonished them not very long ago about their persistence with a very, very strict monetary policy. Because the minute you lower interest rates, you stimulate capital formation and demand. And obviously that would lead to higher company profits. And then on our equity market, your returns, your dividend yields would be higher, you could make a capital gain, and that will attract foreign capital into South Africa.
I was going to say, all of this is going to have quite a dramatic impact on attracting foreign investment.
Well, exactly. I mean, you know, we're waiting. Mr. Ramaphosa has managed to secure 57% of his 5-year target for new investment in South Africa, fixed investment, within the first 2 years of this 5-year target, which is brilliant stuff. But now investors are obviously saying, but, you know, we want to start building new factories. We want to start with investment in South Africa, but to borrow money here is just incredibly expensive. It's hurting demand in our economy, and that, by definition, is hurting GDP.
It seems we need to look back to 2015. Dr. Botha, thank you very much.